Welcome to The Explainer. Today, we're going to try to crack the code of a true legend. We're distilling the timeless wisdom of Warren Buffett into a clear, actionable framework. So let's pull back the curtain and see exactly how he does what he does. First things first, just look at this number. And no, that is absolutely not a typo. Between 1964 and 2003, Berkshire Hathaway's gain was over 250,000%. It didn't just beat the S&P 500, it absolutely demolished it. This right here is why when Buffett talks, everybody listens. The big question is, how on earth did he do it? It all starts right here. Buffett himself says that these 9 words from his mentor, Benjamin Graham, are the most important words ever written about investing. It's not about fancy charts, it's not about predicting the next market craze, it's about one thing: thinking like you own the business. Now, of course, Buffett didn't just dream this up out of thin air. He stood on the shoulders of giants. So if we really want to understand his method, we have to start with his teachers. His whole education started with 2 kind of opposing philosophies. On one side, you had Benjamin Graham, the ultimate numbers guy. His strategy was purely quantitative, just find and buy cheap stocks. On the other side, you had Philip Fisher, who was more like an investigator. His focus was qualitative. Find truly great businesses with huge long-term potential. So what do you do with 2 brilliant but conflicting ideas? Well, if you're Warren Buffett, with a little help from your partner Charlie Munger, you smash them together. And the result was this incredibly powerful synthesis. See, it's not about buying a so-so business for a wonderful price. The real secret, the holy grail, is to buy a wonderful business at a fair price. And this brilliant idea wasn't just a nice thought. It became a system, a repeatable framework. It's a set of 4 critical filters that Buffett runs every single potential investment through. This is the absolute core of his method. So let's walk through them one by one. Okay, so filter number 1, it has nothing to do with spreadsheets or financial models. It's about asking yourself one really simple but brutally honest question before you do anything else. Do I actually understand this business? This really breaks down into 3 smaller questions. First, is the business simple enough for you to explain to someone? This is why he famously avoided a lot of tech stocks for years. Second, does it have a long, consistent track record of success? And finally, what about the future? Does it have favorable long-term prospects? Is it likely to still be a powerhouse in 20 or 30 years? That idea of favorable long-term prospects leads us to one of Buffett's most famous concepts of all time, the economic moat. It's a perfect analogy. Just like a deep, wide moat protects a castle from invaders, a durable competitive advantage, like a world-famous brand or a crucial patent, protects a great business from its competitors. The wider that moat, the safer your investment. Okay, so let's say the business passes the test. It's got a great moat, but that's not enough. Filter number 2 is all about the people running the castle, the management. As Buffett famously said, we've never succeeded in making a good deal with a bad person. You can have the best business in the world, but bad leadership will sink it every time. So he looks for 3 key qualities. First, are they rational? Do they use the company's money wisely to create more value? Second, are they candid? Are they honest with shareholders even when they mess up? Do they openly admit their mistakes? And third, are they independent thinkers? Do they resist that urge to just play follow the leader and copy whatever their competitors are doing? All right, we've got a great business with great management. Now and only now do we move on to filter number 3, the numbers. But here's the twist. Buffett doesn't obsess over the same numbers that Wall Street does. He looks for a few very specific markers of true long-term financial strength. He starts with this metric he created called owner earnings. You won't find this on a standard income statement, but for him, it's everything. It's his personal way of cutting through the accounting noise to figure out a company's real cash-generating power. You take the net income, you add back the stuff they didn't actually spend cash on, and then you subtract what they really had to spend to keep the business running. What's left is the good stuff. He then backs that up with a few other tests. He wants to see a high return on equity, but, and this is a big but, not one that's just propped up by a mountain of debt. He also looks for strong, steady profit margins. And finally, there's the $1 premise. It's simple. For every single dollar the company keeps and reinvests, is it creating at least one new dollar of market value? If not, management is literally destroying your money. So this brings us to the final, and maybe the most critical filter of them all. You've done the work. You've found a wonderful business, run by incredible managers with stellar financials. Now, and only now, do you get to ask the question, so what's the price? And this is a crucial two-step process. Step 1, you, the investor, have to figure out what the business is actually worth, its intrinsic value. That's a number that has nothing to do with the stock price. Step 2, can you buy it for way, way less than that number? That gap, that discount, is what Benjamin Graham famously called the margin of safety. But look, having a brilliant framework like this is one thing. The biggest challenge for most people isn't the analysis, it's not the math, it's psychology. It's having the right emotional discipline to deal with the chaos of the market. And for this, Buffett has a secret weapon. He uses this incredible story that he learned from his teacher, Benjamin Graham, about an imaginary business partner. This partner's name is Mr. Market. And Mr. Market is basically the stock market personified, with all of its wild, emotional, and often completely irrational mood swings. So imagine this. Some days, Mr. Market is on top of the world. He's euphoric. He sees nothing but blue skies ahead, and he's so excited he offers to buy your shares in the business for a ridiculously high price. He's completely swept up in greed and optimism. But then on other days, oh boy, he shows up and he is an absolute wreck. He's panicking, he's convinced the world is ending, and on those days, he's so desperate to get out that he'll offer to sell you his shares for pennies on the dollar, completely driven by fear and pessimism. So here it is, the million-dollar question. This guy is your partner, but he's totally unstable. Would you let his daily mood swings dictate your financial future? Of course not. The whole point is you are totally free to just ignore him. Or, even better, you can take advantage of him. You sell to him where he's ecstatic, and you buy from him when he's terrified. So that's the framework, and that's the mindset. Sounds great, right? But how do you actually start to apply this stuff? What's the very first step you can take to start thinking more like an intelligent, business-like investor? Well, that all really boils down to a major shift in your perspective, and it starts with two simple actions. First, turn off the stock market. Just stop paying attention to the daily noise from your manic partner, Mr. Market. That frees up your brain to do the second most important thing. Start thinking like you own the entire business and focus on its long-term health, not the short-term blips of its stock price. And that leaves us with this final, incredibly powerful idea. Mr. Market, with all his frantic quotes and emotional roller coasters, works for you. You're the boss. He is there to present you with opportunities, not to tell you what to do or what to think. The moment you truly get that, the moment you realize you are in charge, you've taken the most important step on the path to becoming a true, business-like investor.